already joined the webinar, and our live will be waiting for more participants to join. So please remain on standby. We will start shortly.
Yeah, we're hitting those numbers, 92 participants, 93. We got almost 300 people registered. So let's see what's going to be the magic number. But I think, can we already say that this is the most popular webinar?
We can, yeah.
There you go. It's clearly a very interesting topic for the audiences. So including some of our, some of our colleagues at Ancore, they've signed up, so they'll be watching. And yeah, we got two incredible speakers today, so looking forward to discussing all of it. All right, on your cue, Michel, whenever you're ready.
All right.
Things off.
Yeah, let's do it. Let's start, and then if people join in later, then yeah, they will miss the intro, but I think they will be able to participate in the interview. All right, so hello everyone, welcome to SICTIC. I'm very excited that you joined our webinar today with Andreas, Göldi and Emanuele Larocca on valuation. Pavel and myself will be moderating today's webinar. Pavel is the founder and managing partner of Ancore Strategy, the creator and host of the White Spaces Show, a tech and startup show. He works with founders and startups and scale-ups. And last but not least, he's an advisor and big supporter of SICTIC. I myself am a board member at SICTIC, co-lead at the SICTIC Academy, and in my professional life, I'm the founder and managing director of Embark Law, a law firm specializing in advising high-growth startups. For those who don't know what SICTIC and the SICTIC Academy is, here's what you need to know. SICTIC has become the largest angel investor community in Switzerland with more than 500 members, consisting of amazing individual investors and the most prominent VCs in the industry. Our mission is to match smart money investors with the best early stage tech startups. SICTIC holds several startup pitching events, yearly on-site or online. So if you're looking for investment and networking opportunities, then please look no further. You can check out the events on sictic.ch/events. On top of that, SICTIC has launched the SICTIC Academy 2 years ago, providing founders and investors with world-class education material to boost the Swiss startup ecosystem. So this webinar is also part of the SICTIC Academy. And SICTIC has also published the SICTIC Investor Handbook, which is a game changer containing almost everything you need to know for becoming an angel investor. You can order our handbook for free on our website. And also check out our previous SICTIC Academy videos and webinars on YouTube or our website. And last but not least, if you have not yet signed up to SICTIC as an investor, then please reach out to us. We would be thrilled to welcome you. So now I'm going to hand it over to Pavel.
Yeah, thank you so much, Michel. And I'm extremely excited to be here. And thank you so much for the warm introduction. And yeah, we've been at it for, I think, a couple of years now, doing different things for the SICTIC Academy. And I've also been extremely fortunate and lucky to host a couple of FinTech days at SICTIC. So, but I think enough about me. We also wanted to say thank you to our supporters, right? So there's a specific entity that supports SICTIC and most importantly, SICTIC Academy. And we do believe in educating. So maybe, Michel, you want to say a couple of words about the foundation?
Yeah, the Ernst-Göhner Stiftung is a big supporter of the SICTIC Academy. So thanks a lot for, for supporting us financially and for boosting the Swiss startup ecosystem. So big thanks.
Great, wonderful. And then, yeah, without a further ado, we are deep diving in the topic of valuation, and we have two incredible speakers, Andreas and Emanuele, with us. And we're going to be talking about different things in terms of, how to determine the valuation, and then, high valuations that we're seeing right now, and then where do different parties come at these valuations? Obviously, founders want to have high valuations, then do investors want to lower it down? How do you interact within that environment? And then, look a bit in terms of where the overall market is and how things are going. Then in terms of timing, we have an hour allocated to this webinar. So majority of the webinar is going to be spent on the Q&A with Andreas and Emanuele, and then we'll have a bit of time towards the end for the Q&A from the audiences. So what you got to do is just make sure that you utilize the Zoom chat, and then we'll just go through questions from our 125 already participants. So pretty much half of everybody who subscribed to the webinar, and we're hoping that more are going to join. And yeah, towards the end, start putting down your questions to the speakers. It would also be good if you address who you have a question for, and then we'll go through them. I cannot promise that we'll have enough time to answer all of them, but regardless, we'll try to do our best. And yeah, without further ado, I think it would be great if Andreas and then Emanuele would introduce themselves.
Yes, absolutely. Thanks for having me. It's great to speak about this very important topic in front of such a large audience. So I'm Andreas Göldi. I'm a partner at btov Partners. We are one of Europe's oldest VC firms, started in 2000. So I've already lived through a lot of ups and downs with rising and falling valuations. So know that topic quite well. We invest all over Europe, mostly at early stages, and also have an angel network of about 250 very active angel investors who co-invest with us. My personal background, I became a VC 4 years ago as a partner in our digital tech fund. Before that, I was an entrepreneur myself for over 20 years, started my first company in 95 in the early days of the first internet.com boom, and then lived also through a lot of ups and downs there. Had my first exit in 2000, and then also started angel investing and moved to the United States in 2006. Did 2 startups there as the CTO, both were angel and VC financed as well. So I'm privileged to have seen all the aspects of and all the sides of the funding table, so to speak, from these different perspectives, and came back to Switzerland in 2018 to join btov Partners.
Perfect. Thank you. Emanuele?
Thank you. I'm also very glad to be here. Of course, my name is Manuel Larocca. I am head of portfolio management with Serpentine Ventures. We are an early stage investor in Switzerland and Europe. So we invest right now anywhere between pre-seed and Series A with a focus on ICT. That's really the industry we're going after the most. We are a young fund manager. We are been invested for 2 years in the market. We have a portfolio now of approximately 40 companies that we invested. So we have over the last few years discussed with the valuation topic, which is an important one with many companies. Myself, I'm originally from Italy. I have been working with Serpentine Ventures for over 3 years now as a portfolio manager. And before that, I was in mergers and acquisition consulting. So I was advising companies on large transactions, acquisition transactions or merger transactions. And my background is really in finance. I did Bocconi University for 5 years, and I have extensive experience with corporate finance and valuation techniques.
Perfect. Thank you. Michel, on you.
All right. So please, if you have any questions, I address the audience, please put them down in the Q&A section, not in the chat section. So we can, mark them as and tick them off if we have answered them. So please put them down in the Q&A section, not in the chat section. All right, so let's get started with the first question. And the first question is, how do you approach, and determine the valuation of the startup you invest in? It's like a very general question, but it's super important to know, how you approach that question. And I will, first, give the word to Emanuele, and then switch to Andreas. So Emanuele, please let us know how you approach that.
Absolutely. So the valuation topic for startup is particularly interesting because it's true to say that there's no standardized or unique approach to it. So it has to be assessed on a case-by-case basis. There are different valuation techniques that have been elaborated in finance to come up with a valuation, including the discount cash flow model, multiple models, and all of that. These are particularly difficult to apply to early stage startups because the quality of the data that you have, the history of the data that you have is not always sufficient to perform a discounted cash flow valuation. So we don't see that much, and we don't do it we don't use it as much as a valuation technique. Multiples are used to frame consideration, but there are effectively two aspects which I like to point out as approaches which are particularly interesting for valuation of early stage startups. One is the venture capital method, and the other is to take into perspective the structuring of the investment from the perspective of the cap table. So the venture capital model follows the fundamental logic of trying to assess what is a valuation that the company will achieve at, let's say, the exit event a few years from the valuation date, and then discount that back to today as a present value to with the discount rate that investor considers an attractive return, and that allows to identify what is a fair price that should be paid today to access that that particular return. This is, a very commercial valuation technique, but it's also very practical and very true to what we investors do. We have to invest into startups to deliver a certain return. So it's as connected as possible with our institutional objective. The second perspective I would like to can you hear me?
Yeah.
Did you lose me?
Yes.
Yeah.
Apologies. Can you give us an example, of that venture capital method, so the audience, has, better understanding of that?
Yeah, absolutely. So imagine you want to invest in a young startup today, and they come and they do not present for themselves any valuation, which is a typical scenario. A startup will come and say, look, I'm looking to raise some funding, and I would like you to express what's the valuation that you think is fair for me, because for them, it's, typically difficult to presenting themselves. So the venture capital model allows you to make some calculation in the future with a forecast of what you think would be a valuation exit. Let's say you are projected that in the future, the company will achieve 50 million revenue, and that companies in the particular sector that you're looking at are typically traded when they are rather mature with a 5 times revenue multiple, so 5 times the revenue. That means that the company at that point should be worth approximately 250 million. Then discount that back to today with a return that as an investor you consider to be attractive to you. You will have straight away the answer. Typical range for investment return are 20 to 30% for very early stage, even higher if you want to pay for the risk that the company, some of the portfolio companies you're going to invest are going to go through difficulties and eventually not succeed. So that's how you come to the valuation today.
Okay, so basically you estimate the exit valuation, then you do the calculation backwards, right?
Present value to today, correct. That's a commercial price.
All right, then fill us in about the other method.
The other perspective to take into consideration, which is effectively, it's a rule that cannot be broken. It's universally true. The amount invested, the same formula. The amount invested divided by the post-money valuation is equal to the percentage stake that the investor would have in the company after the investment. And so if you reverse that, you try to consider what is the investment that has to be done and what percentage stake you are looking to get into the company as investor, which is really subjective, but it's also a commercial topic to discuss, then you will come to an approximate estimate of the valuation, which is implied by that. It's really an implied valuation. And it's a practical perspective to take into consideration, not to define mathematically immediately what is the valuation to be paid, but to frame a valuation on the basis of the structuring of the deal, and then put that in context of the return you would expect, which you can, again, look in with your venture capital model in perspective of what you're going to get if you invest at a certain valuation, which yields a certain return over your investment horizon. To make a concrete example here, if you consider an investment of 1 million at a pre-money valuation of 10 million, you would have a post-money valuation of 1 plus 10, 11 million. So invested at 1 million would result in that investor getting approximately 9.1% of the equity. Now, this is an aspect to be taken into consideration. Is this a satisfactory shareholding that the investor is happy to have after the investment, or would they want more? Of course, the higher the stake that the investor would require, the lower the valuation. So that is that helps put these elements in context. And it's also one of the reasons why you typically have some rounds which are quite surprising for people, or they really catch the eye when you see a big investment of multi-million ticket and the valuation being very early in the billions. That's also because from a cap table perspective, the more you progress, the more you're going to have dilution as a big topic for the existing investor. And so the stake that is sold in a particular investment round is also an important topic of negotiation that cannot be ignored.
All right. So basically the strategy is that, the investor, just determines like how much, stake in the company he or she, would like to have for that investment amount. And then you basically calculate, the valuation based on these two factors, right?
Absolutely. You can do that to frame what a certain investment ticket and a certain valuation imply, to frame a preliminary indication of what valuation you will need to negotiate to achieve that particular stake that is your target. Correct.
Thanks so much for elaborating on that. Anything else to add from your end?
Well, maybe no, I think it's enough from my side.
Okay, Andreas, it's your turn.
Yes, I think Emanuele explained the two most important methods really well, and maybe I can add some color to that. So first of all, the venture capital method is always a part of it, right? It's typically a mix of these methods. And the problem that the venture capital method has is that it's of course very dependent on market dynamics. So in the last 2 years, we have seen a technology bubble, as you're probably aware, right? Just to give you an example, historically, software companies have been valued around 8 times revenue or so over many years. And in the last year, this went up to about 16 times on average for public software companies, or twice that. Now everything has come down to more normal layers. We are currently about 7 or so. So if you calculated your valuation last year during this boom based on the venture capital method only, then you suddenly look pretty stupid now because you overpaid by a factor of twice. And that's, of course, a problem that we are trying to avoid. But in reality, this is often what happens. The second method is really, I think, the key one, and maybe to add a few details to that. So the first step is really to understand how big should the funding round really be? And the way we approach this is we basically look at the business and we think ahead already to the next funding round, and maybe the one after that already. So to give you an example, if we invest in a software startup at the seed stage, we already think about where does the Series A round come from in 18 to 24 months. And what does the company have to achieve to raise a Series A? And as a rule of thumb, for instance, in software, you typically say that the company should be making about 1 million in annual recurring revenue. So that's about 85,000 in monthly revenue. And we basically have to see a path to the company achieving that kind of financial performance. And then the question is basically, how much money does the company need to get to that point, right? How many engineers do they have to hire? How many sales and marketing people and so on? And so you back your way back into the number that what the round size should be. And let's assume it's 2 million. Then as a rule of thumb, in most cases, at least in software companies where I typically invest, the standard dilution for a Series C or Series A is about 20%, right? On the chart that Emanuele later showed, which means basically you're looking at an 8 million pre-money valuation as kind of the baseline where market average, everybody starts the discussion. And then you basically start the negotiation process between investor and founders really, right? So for instance, if you see a team that is really, really strong, experienced serial entrepreneurs, they probably can get away with less dilution, so it means higher valuation, right? So we'll go down on the chart here. If it's a really interesting market with great dynamics, not too much competition, this would also increase the valuation. Again, if we see it's a very interesting exit story, potentially, this could be a company that Google buys for 5 billion in a few years, also increases the valuation. So a lot of these topics go into where you at the end of the day land in terms of dilution and as a result for the pre-money valuation, right? And at the end of the day, the important thing is really that all of this taken together has to make sense. I think the best investors are really those who spend a lot of time with companies to really understand the business and then basically conclude the valuation based on all these input factors to get to something that is really sustainable. And I think we're talking later about valuations that are very high and maybe too high, because that also goes into that.
Perfect. Now, there's when you decide on the valuation, you know, that you want to negotiate with the startup. I mean, how many scenarios, you know, do you discuss with your you know, fellow investors? You know, I mean, how much detailed, you know, are these scenarios?
I mean, our scenarios internally are very, very detailed. I mean, we typically write investment memos that are 10 to 15 pages, have a detailed scenario analysis, what's going to happen with this company, with what kind of probability. It's less of a financial exercise. As Emanuele said, they typically don't have a lot of data, right, for very early stage companies, and not, in most cases, not even as an established working business model. So you have to go on other more qualitative factors, but you have to look at them in a lot of detail. You have to understand competition and so on. You have to understand what do early customers maybe do, how much are they willing to pay. All these factors go into these scenarios, and you have to do this in a lot of detail again. We discuss this, of course, internally at length, and we also, if we co-lead around with another VC, we of course also share this information and these perspectives so that everybody at the table can basically come to the same conclusions. And we also share it with the founders, which is very important, because the more transparency you have and the more you agree over what are really the parameters for this business and what do we think we have here, right? And how does this grow and become successful, the more aligned you are between founders and investors, and that's typically a predictor of success.
Thank you. Pavel, we have a couple of questions from the audience. Just so you know, maybe we can, you know, go through that, you know, later on. But like first, you know, I want to follow on with the question to you, Andreas, that you know, is the approach, you know, on valuation different when you're an angel investor in the VC? And if yes, then, you know, can you elaborate on that a little bit?
Sure. I mean, one difference is, of course, we have an entire team that can spend many hours on analyzing a company and come up with these very detailed analysis. The typical angel probably doesn't do that. It wouldn't make a lot of sense, of course. So it's maybe a little bit more intuition driven or experience driven. The second major difference is really that angels tend to have somewhat different return expectations that they are happy with. So for instance, if you're an angel and you put 50,000 into a software company and after 3 years it exits for a 5 times multiple, you walk away with $250,000, probably makes you quite happy, right? For a venture capital firm, a 5x return is not a great outcome, to be honest. For our business model to work, we need 10x, 20x, 50x, right? So we shoot for companies that have the chance to become these outlier successes, because historically, that's really what drives the best returns in venture capital. We have these huge successes and then a portfolio of companies that are not doing as well or maybe even go out of business, but we have a large portfolio and therefore want to go after these outliers. So we are, when we think we have one of these companies in front of us that can be a 50x success down the line, we are a little bit less valuation sensitive than your typical angel who might be happy with a 5x outcome, right? Because then it makes quite a difference for what your entry evaluation is. But for an early stage VC who also participates in follow-on rounds and so on, it's not that interesting or that important as for an angel investor. And we typically, again, because this is just the way venture capital works, we take significantly higher risks with more what we call binary outcomes, right? Either it becomes a huge success or it goes to zero, and in between, the zone in between is not super relevant for VCs, but it can be extremely relevant for angel investors. So my best investment that I had as an angel was a 20x outcome, made me very, very happy, right? But again, for a venture capital firm, that's one of several companies that have to reach that kind of level.
From from your side?
Look, I think Andreas summarized it very well. I mean, one key difference that we see is that when there is an engagement between investor and the startup, which is when valuation is defined, really, it's the resources you put at work, and depends on business angels, but it's true that as a professional venture capital investors, we have a team that looks at things, that makes different analyses, runs a due diligence, which is thorough around every corner, because that's our job. So it's the depth of the analysis that we can go into that helps or can make the difference. But fundamentally, the main difference is the return objective. We have an institutional objective that we promise our clients, our limited partners, to achieve, and we need to find these opportunities that that in the long term return this very high range. So for us, it's very crucial to identify opportunities which could achieve that in the perspective of a long-term strategy that has to deliver on a fund basis. So we look at the assets on a portfolio basis to understand what are our chances on a scenario basis that those return the valuation that we look for. And then we have to identify with the scenario analysis that has been mentioned before, what are potential outcomes if things go differently than we expected. We also have a let's say, time horizon, which is very different from that of business angels. We have to return our money in a certain period of time. And so that's where we have to consider that as part of the element for how fast the valuation moves from where we start today, so the valuation which is negotiated today, to the outcome. That for us is also very important.
Pavel, anything that you would like to ask on that topic, or would you like to move forward to the next question?
Yeah, let's definitely, also in the interest of time, move to the next question. And I'm seeing a lot of the questions coming from the viewers, and I think some of them we're going to answer already with our predefined questions, so hang tight. And I would really like to stick with Andreas for the next question, because we already touched on the topic of angels and founders and VCs. So we obviously saw a lot of high valuations in the bull market in the past few years. So obviously, how do angels, founders, and VCs look at valuations? Clearly, there is a difference, and some are buyers, some are sellers. And then most importantly is what happens when things get tough, right? And then there's a potential down round. So I'd like to start with Andreas, if you could take this on.
Yeah, sure. So speaking of high valuations, I mean, one problem that we've seen in the last few years is that valuations got driven up also by competition between VC firms, right? So the number of VC firms has almost doubled in Europe in the last 5 years or so, and obviously more money is now chasing not that much growing number of interesting startups. So that has driven up valuations, sometimes beyond the level that is still rational in terms of the methodologies that we discussed earlier, right? It was a pure question of supply and demand, suddenly a lot of money in the market, and that drove up some valuations to fairly rational levels. The second aspect we already discussed, that the markets, public market valuations were extremely high. That drove up valuations as well, often well beyond what was obviously sustainable. And now this has come down quite dramatically. We are now down in the US market almost 50% from the peak. And in Europe, it's also starting to hit very clearly. From the part of the founders, one problem that we've often seen is that founders kind of tie their ego to their valuation that they can get, right? It's kind of this external validation. Somebody tells you your company that you just started is worth 20 million, that really feels good and so on. And then you often take money from somebody who pays this high valuation that might not be necessarily the best investor for you, and a valuation that is very hard to grow into because you're getting value that what the company might become, right? Not what it is now. And actually proving that you are going to be so successful to justify this very high valuation is very tough. So the result of that is what you just alluded to, that we are now increasingly starting already in the market to see down rounds, which means that the company suddenly, because it's threatening to run out of money, has to raise new capital at a valuation that is lower than the last round, or maybe the same. And that is very painful, because that means that typically founders get diluted quite massively, existing investors as well, but existing investors often have an anti-dilution clause in the contract, so which reduces this effect a little bit, so the ones who typically suffer most are the founders. And again, the higher your previous valuation was, that you now suddenly can't command anymore, the more dramatic this effect is. And I actually, just as an anecdote, experienced this myself in my time as a founder in one of my companies in the .com bust in 2002. We had to raise a round that wiped out almost 99% of the existing shares. So I had to buy my own way into my own company, which was fine. I mean, the company later succeeded and so on, but it can get quite dramatic in a massive downturn, so that almost everybody can even get wiped out. And that's, of course, extremely difficult for a company to recover from. So again, the summary of that is basically, we always recommend, yes, if you can get a high valuation as a founder, fantastic, right? But don't exaggerate it, because you have to go into this valuation even in more difficult market conditions. And as an investor, yes, of course, you want to pay a relatively low price if you can, but the best companies can get high valuations. So if you just optimize for a low valuation, you're probably not investing in the best opportunities.
Perfect. Thank you so much, Andreas. And Emanuele, what are your thoughts on this?
I think it is typically a big topic, right? In the venture capital community, is always like a bad word, down round. All of a sudden, you know, people get nervous about that, because it is true that it has a very, you have a variety of negative effects. So one instance, of course, from the perspective of the investor, assuming you get onto the last round, which has happened, you know, what you have seen in 2020, 2021, competition and the different style adopted by certain VCs has pushed valuation upward at level which everybody was sort of dubious about, but still they were contracted and they were, you know, invested at that. And then all of a sudden they have to realize losses which are quite significantly, and which it will probably make it for that fund, that investor, very difficult to recuperate properly in the future. But also importantly, what's very important perspective Andreas mentioned is from the perspective of the founder. It's clear that a founder would have an incentive to get as much as a high valuation as possible, because yes, it's ego, but it's also like personal return that they have on their own shares as a founder. So I think what's important to mention here, that it should be, and we see it very clearly as a Serpentine, it should be a mutual relationship to try and find what's a valuation that makes sense for the construction of the future. Putting a fund as an investor, taking a high valuation, you put the fund on the pressure to, for the next round, finding something which is even higher, because par round and down rounds are not nice. So setting the bar that high, you're going to put a strain on the founder that can be bad from many perspectives. So it's also from the investor perspective, we believe we need to have some responsibility in identify an optimal path, discussing that with the founder transparently, from the current round to the next round to the next round, because in this industry, the companies that get venture capital money, they will have to do this with a certain frequency. And so that's an important perspective to keep in mind.
Perfect. And a bit of a kicker question from my end. So I would say for both of you, raise more often and smaller, or raise kind of bigger and then continue building? What would be the best practice?
I mean,
better practice.
I mean, on balance, probably raise bigger rounds less often, because it's very time consuming. The CEO typically spends all her time on fundraising and during these phases. So that's not necessarily the best way to spend your time. I would definitely spend enough time to find the right investor at the right conditions. I think many founders, because they think that fundraising is annoying, which it is, totally get it, just jump to whoever writes the first term sheet, right? And that's normally not a great way to do it. So don't optimize when you pick as a founder, your investors, don't optimize just on speed or just on valuation. Really figure out who the right investor is for you, and then do one really nicely sized round that gives you enough runway for the next 2 years or so, and then can actually go back to building.
I generally agree, and I think here the perspective is also when you take an investment round, what you're basically doing is you're body resources to bridge from that point in time to the next point in time. So having like short loops means that you raise resources with a planning with a 6-month horizon. That's, you know, being quite short-minded, and it's not really helpful for the founder, because the founder will move from sign the contract to you to having to talk to new investor right away the day after to finance the next round. Fundraising, you don't know how long it's going to take. It can take 1 week if you are in certain very special condition, or it can take 6 months, 9 months. It really much depends on the situation. Obviously, no one has an incentive in a fundraising process to last that long, but that might be the situation. And so planning with a short-term horizon is suboptimal. I would say for both lots of time spent by the management team to tackle investor questions and convince people that they are a great team, which is distracted from running the business, which is the most important thing. So as a rule of thumb, would be better to, with the current investor, which has to be, you know, the right partner, plan for a long enough time that you will be able to deliver what you commit to deliver over that investment period. And then at that time, find a new partner to go to the next phase.
Perfect. Thank you both. Michel, over to you.
Thank you, Pavel. So just wanna ask one question from the audience, you know, to you guys, which basically, you know, is also, you know, connected to the next question. At what point you exit your investment? And the question was asked by Matt, and he asked, do you have recommendations on what percentage the founders should definitely retain along the route from pre-seed to A round?
Yeah, I mean, again, the rule of thumb is that you get diluted by about 20% in each round. That's fairly standard, and some founders less and some a little bit more, depends on that. If it's more than that, it's problematic. I mean, you sometimes see companies that were, you know, in a company builder or got or raised a very strange angel round. Unfortunately, that still happens quite a bit in Switzerland. And then you get to a seed stage and the founders have already given up 50% of the company. That is very hard for VCs to touch, even, because we normally say that after the Series A, the founders should ideally still have quite a bit above 50% of the company, at least, ideally more than that, right, to stay motivated. And you also have to calculate in that you need an option plan for employees. That's another 10% and so on. So if investors get greedy at the earliest stages, that's not for the benefit of the company at all, right? And fortunately, we're seeing less and less of that. But also for angel investors, sometimes you have naive founders who are willing to give up 40% for the first 200,000 or so. Don't do it. This is not going to be a successful company, quite simply.
Thank you.
I think it's very important, again, to keep the founder's perspective in mind, because you can imagine that they will look at that. And it's true, as a rule of thumb, dilution can range anywhere. We have seen anywhere between 10 to 20-25% each round. And so if you start to make that math by the Series B, so third financing or so the company will have raised, the founders will be in a position where they go at below the psychological threshold of owning at least 50% of the company. That's also very important to consider. So as Andreas said, not only is not beneficial for the company to be as investor to be greedy, but it can be a poison pill for the one who has to the investor that has to decide next, because they will walk in, they will see a cap table which is either where the funders are very diluted or is very crowded. Those are elements that can even be a deal breaker. And so creating those situations to get the best possible outcome as an investor can really backfire in the ability of the company to actually raise the next round, which is crucial.
Okay, so the takeaway is that, you know, if you set the valuation, you know, too low as an investor, then yeah, it could, you know, be detrimental to you, and founders, you know, lose incentives, and the company, you know, is likely to fail. Maybe that's the takeaway, right? All right. So I have another. We have another super interesting question, which is, you know, at what point, you know, do you exit your investments, you know, with a look at valuation? I mean, you talked, you know, about the different expectations angels and VCs have, and I mean, if the startup, you know, is a home run, then this question is obsolete, right? But like, you know, if the company maybe struggles but still has traction, then, you know, at what point in time do you exit your investment, you know, with a look at valuation?
Yeah, I mean, first of all, the best companies don't get sold, they get bought, right? So they either do an IPO or they get acquired for a lot of money from a very, very big acquirer. So that's the ideal case, of course, that everybody is shooting for. But as you mentioned, there are, of course, many cases where you don't succeed like that. And at some point you consider, okay, what do we do with this company? Should we try to sell it? Should we try to exit our position entirely and maybe find somebody else who wants to buy it from us? So there's a lot of gray area there. And you see quite a bit that companies that are succeeding quite nicely, but not wildly, at some point then get sold. So the investors will probably hire an investment bank that then shops it around with potential acquirers, and typically can get a fairly decent exit, right? And I would say there's no rule for when you do that. It's typically when you feel that, you know, this company is going to struggle to really reach the next level of success independently. It's probably better to have a bigger parent company or different source of capital. Maybe it's private equity or whatever. So I don't think that there's a really clear rule, especially also from the point of valuation. I think from the perspective of angel investors, what is very important to understand is that very often in follow-on funding rounds, you sometimes get the opportunity to exit your investment early on, right? And we have quite a few angel investors who say, you know, if I can get a 5 to 10x return and I get this after 3 years in the Series A, why not, right? Because when a company raises, for instance, a very large Series B, the risk profile changes quite significantly, right? This is not a company anymore that has, you know, a 60% chance of succeeding somehow. It has a small percent of succeeding wildly and a very large probability of not succeeding at all, of going to zero. And not all angel investors are happy with that. So again, this is also something as an angel to consider. If this is being offered in a new round, can you exit, and do you want to exit prematurely? Can work extremely well for angels.
I mean, I agree with the most important with the first statement, that basically when to exit is only partially a decision, because it's you as an early investor, you entrust the company to develop to their fullest potential, at which point, yeah, either they're gonna decide to IPO or they're gonna find a partner to acquire them. So it's really entrusting the team to you know, on the long run as an investor. Of course, as an angel investor, it's clear that you're going to have opportunities along the way. And I think realistically, if you have achieved return on cash of cash basis, which I think is satisfactory, you should consider it, particularly if you, depending on your involvement with the company, so to say. Selling means that you're not going to be involved with the company anymore. So you have to take that into consideration. As we see, investors for us, might be an option if we have considerations about we have to deliver the return to our investor because we're approaching the closure of our investment period, if that's even a consideration. But otherwise, we invest on a mission to stay with on the long run with that company, and to empower the founders to find the optimal outcome, which in our perspective, or what we're looking for, is a founder that can drive it to this 20x, 50x, 100x, which is, the objective. So that's where we would set the bar, obviously, because that's where we have to do. But there, I believe, and we see more and more opportunities coming for secondary exits. So meaning you're selling your stake into the company to other investors. We see a growing market there. It's clearly an interesting segment because of the many positions that have been created, small positions, but also positions that are interesting. You have seen that with the pre-IPO market, that was really hot. Obviously now it's not a great opportunity anymore for some time, but short answer is, if you have achieved your financial objective with the investment, and that was the outset, that could be a good time to consider.
Over to you, Pavel, for the next question.
Michel, I'm thinking in the interest of time, we got about 15 minutes, and I'm seeing that our Q&A section is just, overwhelmed with different open questions. So maybe we just move into the Q&A section if you don't disagree with this.
No, not at all. Let's do it.
Perfect. Okay, so first of all, thank you so much to both Andreas and Emanuele for an exciting Q&A discussion. It's been, we're getting really good feedback from our audience. So I'm just gonna try and look for some of the earlier questions. Just give me a second. I think one of the more interesting things was for Emanuele from Holger Willems. So is the 20 to 30% discount rate or the total ROI, what is the average duration taking into account from investment to exit, approximately 7 years?
So what I was mentioning is really a discount rate, because it's a methodology which fundamentally draws into present value type of methodology. So you project your let's say your gain in a certain period of time, and you should also use your assumption for what's your investment horizon. As investors, we have a long investment horizon. We can withstand even 10 years as return. Of course, the longer it goes and the higher the return we want, the lower is the valuation that we should take today. So we have to take into account, is it a company that we are convinced we can exit in 8 to 10 years? That is an assumption that we have to make, also in perspective of there's going to be different financing until then, and then the company will have expressed their fullest potential. So 20 to 30% is a general rule that has been, used to consider an investment that is fairly successful because of the risk that you take there. And 7 years it's a somewhat reasonable horizon for a VC investor. From the perspective of the angel, that might be even shorter. And so you can consider that you're trying to, for example, in your model, to exit your position sometimes 5 years from now, because you're going to find some secondary exit opportunity from some other investors, and that's your investment horizon, which allows you to find the optimal valuation today.
Perfect. Andreas, anything to add to that?
No, no, I think we can go to the next question.
Perfect. Do you want to take the next one, Michel?
Yeah, so there's Bastian, and his question is, how do valuations for startups in Switzerland differ from other countries? And I mean, looking at, let's say, EU, US, China, Japan, Middle East, what is your experience there?
I mean, every region has kind of a different baseline for valuations that people consider to make sense, right? The most expensive one is probably Silicon Valley. I mean, a company that would be valued at, let's say, 10 million in Switzerland probably could get, or was able to get until last year, about 30 million in Silicon Valley easily, right? So it's a very significant difference. We also see the same effect inside of Europe. I mean, Switzerland is relatively expensive. A place like Berlin is even more expensive because there's a lot more competition between VCs. When you go to a place like Poland, where I just made my last investment, you suddenly pay half of what you would pay in Berlin, right? So for the same quality of company. So it can be quite wildly different is the bottom line. And this also makes it a bit interesting because in the pandemic, because everybody was suddenly on Zoom, we saw a lot of international investors come into markets like Switzerland who were happy to pay Silicon Valley-like valuations in some cases. So this was another factor that drove up valuations quite substantially, and we'll probably see a little bit more normalization around that now.
If I can spend a word, I agree. And I think I would say we see there is, if you look at the same level of maturity of the company, so let's take seed, it is true that different regions have different valuations. the typical gap everybody looks at is US versus, the rest of the world, because US is the most established market, and it's true that the valuations there seems to be different from the others. But it also means in an interconnected world like today, the investors that are looking at those valuations there, they're going to come in a different region, find a different set of valuation, and try to put them in perspective of where they should allocate their money. Because if you take global investors, the most reputable VC global investors now, they're very attracted to the European opportunity because they find great opportunity, great business that's been done. Fundamentally, the value of a business is the value of the potential you see for it. So in the US, they start with the reference market being 300 million people country to start with, and then that comes global. A company here in Switzerland that has the local audience to start with probably might get challenged on that. Will you be able to get out of Switzerland? Will you be able to grow to global? And that's what you're really looking for. So if you are on the same mind that the company you're looking at will reach the global audience in perspective, there shouldn't be any difference. Reality that there is, because valuations that you see in the venture capital market are commercial prices discussed and found by professional investors. And to give you a concrete example, if you look at, we took last 2 years baseline valuation for seed, so average valuation for seed, you can see that the US is 1.5 to 2 times higher consistently. But that's, not something that you should put in the perspective of that is so much more expensive, and so it's something to exclude in the perspective. Once again, valuation should be taken in the perspective of the potential of the business you're looking into and nothing else.
Thank you so much for elaborating on that. Pavel, do you want to take the next audience question?
Sure. Definitely. So there are a few questions on team, right, which I think is quite an important one, because valuations and calculations are super important. But if you're coming at an early stage, clearly it's whether you believe that the team is going to be able to achieve that. So Beat Müller is asking, what is a good team constellation for investors, and what are respectfully, what are the red flags?
Yes. I mean, first of all, you'll sometimes hear that in early stage investment, there are only 3 things that count: team, and team. And that's wrong, because it's really about the right team for the right market with the right product, right? That makes a company successful. We've seen brilliant teams who just were in the completely wrong market and had a dumb idea, frankly, and that fails as well. So what does make a successful team? Again, what we are looking for is extremely important, to have the right founder market fit, right? Not every kind of founder performs equally well in every kind of market, obviously. It really depends on what the customer problem is that they're trying to solve. In some cases, you are looking for very experienced founders. In others, you are looking for young founders who have very wild, creative ideas. It really depends on that. What is very important is we look for the right size of founder teams. So historically, solo founders, just one founder, are typically less successful than whole teams. But when a team gets too big, beyond 4 or 5 people or so, then things typically get messy and it's not clear who makes the decisions. So typically the sweet spot is 2 or 3 people founding team. And we look for very complementary skills and backgrounds, right? So ideally, for instance, you have a business-oriented founder and a technology-oriented founder, maybe another person who has a slightly different profile. That's ideally what works best. And diversity in other aspects also typically make a company much more successful. I mean, there are plenty of data points about that. And it's really about the right mix, basically, and about the right founder market fit.
I think I share most of the views. In particular, I think one element which we find quite to be difficult is solo founder. So solo founder, it's many things. There are many reasons why a solo founder is a higher risk proposition, simply because you only have one person that's doing the job. And if that person, for whatever reason in life, drops the towel, then, it's done. So a team of people who you assess and believe is the right for the market, it's absolutely essential. So you have to have the trust that that person has clear vision and a clear execution plan the team has a clear vision, a clear execution plan that's convincing to bring that proposition into the market successfully. I would say complementarity of the team is also very important. If you have a team that's entirely shares exactly the same profile, there's a risk that they're going to fight each other on that particular area because each of them will think they have the right answer and might be problematic. Another dimension, which is very, very important, is cohesion among the team. So first, you look to find a team which is complementary of people that are fit to the mission, and they're clear about the mission and how they're going to bring it to execution, but also cohesion. Attrition between founders is very, very dangerous. So if you believe that those people are there together, but they will not stick around together for long, or one is going to leave, or they're going to break apart and fight the whole time, that you can consider very easily a red flag, because it's going to create problems, and it's going to create significant problems.
Perfect. Thank you. I think we got time for one last question. Michel, you wanna take that?
Yeah, sure. I mean, there are like two questions. One is, I mean, Andreas and Emanuele, you can decide which one to answer. One question is, since COVID, conditions have, become tougher for startups, and, how is the outlook, 12 and 24 months from now? And the other question is, are there, any tricks or anything that you can do as a founder to, to boost your valuation, or as an investor also, to manage the valuation, let's say, when negotiating the deal?
Yeah, maybe let's take the first one first, maybe quickly the second one. I mean, the dynamic was actually such that at the beginning of COVID, everybody was kind of very shocked and so on. So for a few weeks and months, the market was very difficult. And then the opposite happened again, because everybody was on video, the market was suddenly much more fluid, valuations rose, and conditions also became much more flexible in most cases. And now with the current downturn that we are experiencing due to inflation, et cetera, we are seeing quite the opposite. Now suddenly investor conditions are getting stricter again. We see sometimes higher liquidation preferences and anti-dilution clauses and so on, stuff that we have not seen for years are now suddenly back, especially for down rounds, right, where investors have the leverage. So I think to some extent, as a founder and investor, you just have to go with the market climate. I mean, there's not that much that you can change about that. And very experienced people on both sides typically listen around and ask around what the current market conditions are and what they can get away with. Again, it's typically not in the best interest for investors to get too extreme with these things. That typically backfires at some point. But right now, investors are in a stronger position, definitely compared to, let's say, the fall of 2021.
It is the case, and for many reasons, because as investors, we invest money of our clients, and we have to deliver return on that. So you can imagine that our clients are also going to ask us, okay, so what's the market now? Where are our opportunities, and where are we going to have our troubles? And that has to be assessed. Puts on professional investors a new kind of pressure, which is, I have to deliver, I have to be more careful, I have to be more watchful. And that's why you see the change of tone. From example, for the last 2 years, the rule of thumb was like grow at any cost. And now the rule of thumb is, be careful, watch your finances, try to maximize it. That's kind of a consistent feedback that startups are rumored to be getting. Reality is that, you have to consider how the market is affecting your particular company. And a concrete example, when COVID came and everybody was super scared, there were companies that were actually in a great position to benefit for those trends. So you have to take into considerations. And considering the current conditions, there are disruptions which are going to still be major for example, the rising interest rate is a macroeconomic condition that creates troubles. The supply chain disruptions that you had because of shortages of certain components, because of shortage of certain delivery routes, and now because of geopolitical instability in Europe with the Ukraine situation. These are things that have to be taken into perspective to try to assess what's the effect on the particular business I'm assessing, and does it affect valuation at all for that business? Markets are also very important. Public markets are one exit route. Right now, we are facing one condition which is objective, and we have to deal with it. You cannot change the market, as Andreas said. So you have, at the end of the day, you have to, make a reality check and just be honest on what's achievable and what's not. And at the end of the day, investing, it's about making at a certain point some financial returns, and that is true. That is true to it.
Thanks so
Just
much.
on time. We're just on time. In the best practices of and heritage of SBB.
Right. Paul, would you like to close the webinar?
I'll leave this one to you, Michel.
Okay. So, thanks so much, Pavel, Emanuele, Andreas, for joining this webinar, and especially you, Andreas and Manuel, for sharing your valuable insights, and also many thanks to the audience who participated. And please reach out to us or Andreas or Emanuele if you have any other questions. And if you haven't signed up to SICTIC, then please, do it. And if you have any questions, you can reach out to me or to the ops team or to anyone at SICTIC. And again, thank you, Ernst Göllner Stiftung, for supporting the SICTIC Academy. And yeah, this is a wrap.
Thanks so much, everybody. This was great. And again, thank you for the audience. Very lively, loads of participants, a lot of questions. Apologies, we couldn't answer them. So I think we need a follow-up session, definitely. Maybe just the AMA with both Andreas and Emanuele. So thanks, everybody.
Thank you, everyone.
Thank you, everyone. You have a great day.